In 2017, the U.S. and Chinese economies both grew at a strong pace. The U.S. Federal Reserve has forecast 3 interest rate hikes in the country next year, and the European Central Bank is likely to start rolling back its asset purchasing program. What are the prospects of global growth in 2018? To discuss the prospects and challenges ahead for the global economy in the next year, today I am pleased to be joined in the studio by Paul Sheard, Executive Vice President and Chief Economist for S&P Global, and Professor John Gong from the University of International Business and Economics. That's our topic. This is Dialogue. I'm Yang Ray. Welcome to our dialogue, gentlemen. With the New Year's Day around the corner, the U.S. state approved a massive tax overhaul plan, the largest change to U.S. tax law since the 1980s. After the tax cut, the bill takes effect, the U.S. corporate tax rate will be cut to about 20% instead of the previous 35%. What do you think will be the major impact upon the U.S. economy in the first place when President Trump vows to put America first and to increase the employment rate and also to create more opportunities for overseas investment, particularly perhaps to attract American multinationals to come back?
I think there's a number of ways, Ray, of looking at the tax package. The corporate tax cuts really translates into some fiscal stimulus for the economy, which should help to buoy growth in the shorter term. But I think the real intent...
Short term, not long term. That's a very important.
So the short term for the stimulus, for sort of macro economic demand management. But longer term, of course, the real intent of the tax package is to simplify the tax system, make it more efficient, and particularly I think the thinking of the administration is very much the idea of incentivizing capital investment by companies. So companies, by dropping the tax rate, making it much more attractive to try to make profits, and companies make profits by investing, hiring workers and producing more output. So it's a real key element here of the sort of Trump administration aspiration to lift the growth rate out of the 2-ish zone that it's been in, really around about 2.2% since the financial crisis or the recovery, and lift that up to something like 3%. That's really the ambitious target here.
I'm afraid this tax cut plan was applauded not only for the narrow margin by only 2 votes. It's 51 against 49 in the Senate. It's also because of the huge success for President Trump to get what he wants down. And what do you think of the immediate impact?
It's a major legislative success for him. He hasn't got news for him ever since he came to office last year. So this is a major breakthrough for him.
A shot in the arm.
Yeah, exactly. And I haven't looked at the Senate bill yet. I tried to find the exact, the version, the text of the bill last night before coming here today. I still can't find it. They haven't released it. And the bill actually talks about 15% corporate tax rate for American companies. But Donald Trump later said that he might adjust this to 20%. And I think the impact is, he's talking about increasing investment from corporate side. But I think really the immediate impact is in terms of attracting corporate cash from moving to the United States. So there's a lot of money sort of depositing islands in Caribbean islands, in these countries, and the money will be pulling back. Now, in terms of whether the money will be really put into capital projects, I think there's still ways to be seen.
What are the factors of uncertainty, Paul?
Well, I think one uncertainty as we speak today, Ray, is exactly what the final bill actually looks like, because what's happened, of course, is there are 2 bills on the table at the moment as we speak. One is the House of Representatives bill. The second one is the Senate bill. And the Senate, so they're a little bit different. And now there has to be this process of so-called reconciliation, which basically means taking the 2 bills, which are a little bit different, both Republican tax reform bills, and making them into a single bill that both houses can pass and then lands on President Trump's desk to sign. So that's sort of one uncertainty of, we're not quite there yet in terms of making sure this actually happens. But as John said, it is really important for the President and for the Republican Party to get some policy runs on the board here. Obviously, health care didn't work out so well, the reform and repeal of so-called Obamacare. The midterms are November of next year, and typically incumbent presidents, new incumbent presidents, that party doesn't do particularly well at the midterms, and there's a very slim majority that the Republicans have in the Senate. So there's a lot riding on this bill, not just economic issues, but also the political issues.
But do you think the tax bill is likely to increase the chance for Republicans to win the midterm elections by November next year?
I think it will definitely be an item in the positive column from two perspectives. One is the optics of getting some policies actually done, of showing that the Republicans, which have the Congress and the White House, can actually achieve some policy victories. But then also in terms of it will provide presumably some stimulus to the economy in 2018. The economy is going into 2018, as you noted in your introduction, in pretty good shape. Yes, the Fed is slowly normalizing monetary policy, but monetary conditions still remain very accommodative. If you get a bit of a fiscal shot in the arm to the economy, that will be good for growth. And if they could achieve 3% growth over a number of quarters, that would certainly give the Republicans some pretty good talking points going into the midterm elections.
John, what are your thoughts on the factors of uncertainty that may prevent the tax bill from being translated into reality?
Well, I was about to mention that this is all sort of the second version of the trickle-down economics of the Reagan era, and the risk I think here is that whether it will really stimulate capital expenditures in a big way, so that it can, first of all, it can make up the tax loss because of the tax rate cut. Second is that whether the companies will actually, really increase the capital investment in a big way, that's still very uncertain. I'll give you two examples. In the state of Kansas, for example, they actually have slashed state income taxes, and they find out that it doesn't really stimulate the economy, and they went back and actually hike the rates again. I think Washington Post a few days ago published another article talking about the state of North Carolina. Very similar situation. They got a kind of an income tax cut in the state of North Carolina, but they actually don't see the benefits immediately. So the jury's still out there. I think it may probably take some few more years to materialize these stimulus effect. But at least I think in the short run, I'm a little bit skeptical about whether it can give the economy sort of a shot immediately. So it's ways to be seen. That's a major risk.
What will be the overflow impact on the Chinese economy? Some of my friends who are returned scholars, economists, and who are CEOs of the overseas multinationals here in Beijing or Shanghai, they are concerned that some of the R&D of the overseas multinationals will go back because of the corporate tax rate is so attractive, like what Silvio Berlusconi did in Italy. Whenever he was involved in the campaign, he always gave very generous promise about tax cuts, and then most of the cash and capital would go back to Italy, and his approval rate went up immediately. So what do you think of a similar message that President Trump
That's
did?
very real. That's very
real.
Very real. And I think offshoring is already happening. Even before this happened, American companies are already sort of withdraw some of the activities back home. And this is, in a historical context, is nothing surprising to me, because the clustering effect tends to move from one location to another. Used to be in Europe, later moved to North America, come to Asia, to Japan and Korea, South Korea, now coming to China. And it's been in China for 20-some years. And it's actually about time that capital is actually moving out. The outward FDI amount is already exceeding inward FDI amount in China right now. So this is actually not surprising to me. It's already happening.
Are you saying that we have enough liquidity in the Chinese market that we are not afraid that there will be outbound flight of capital, particularly the withdrawal of overseas multinationals, to say nothing of the level playing field that we started to introduce, and that starts to scare some of the overseas employers here?
From Chinese government's perspective, of course they want these investments to remain in China, right? But this is something they can't stop. I mean, it's happening in a big way already. It's actually not just American companies, also Chinese companies too, right? They're moving out of China, to be honest with you, America is actually quite attractive place. You know, the automobile glass company, Fuyao Auto Glass. They built a big factory.
That guy from Fujian went to Chicago?
No, I think Ohio. I think
Ohio.
It's the state of Ohio. There's another plan from Foxconn. They're going to build another big factory in the state of Wisconsin. So actually, you know, look at the cost structure in America. Electricity, land, right? Other than labor is a little more expensive. Other stuff is actually very competitive with other countries. So I think aside from those sort of normal investment, actually I'm more concerned about the hot money. And in China, we actually have a lot of hot money.
But don't forget, we haven't opened up the capital account. So, and the Chinese authorities have tightened their grip on the outflow of the capital.
Exactly.
In that case, do you think the Chinese enterprises would have easy access to the overseas market?
Well, I mean, it is a big motivation, I think. You know, it's a big motivation. But, you know, people here are very creative. They will come up with different ways of buying assets over there. Hotels, for example, real estate assets.
But I'm afraid Wang Jianli has been given the early warning. And he's behaving very cautiously.
The government is very kind of not very happy with this. So Chinese government is going to, our government is going to impose a more sort of a stringent control on this. But I think that's a very real thing. You know,
Can I come back on this issue of what this means, the tax plan in particular, what it means for the Chinese economy? I think a key issue here to sort of answer that question revolves around a judgment of how much so-called slack is still in the labor market in the U.S. And there's uncertainty about this. The headline unemployment rate is very low, 4.1%. But there are other indicators that would suggest that there's actually quite a lot of room for the labor market to get stronger before inflation actually comes. So we may test that proposition with this the tax cuts, in the sense that one of two things could happen. As we were talking before, it could just layer in some extra stimulus into the economy, cause more jobs growth, but not cause inflation. So let's say growth picks up to 3%. That's a pretty good news story. It means stronger growth in the US, more Chinese exports. And I think if the economy really was growing at 3%, even if there was a substantial Chinese trade surplus with the US, President Trump might be inclined to look the other way. However, if, as the Fed is suggesting, the economy is more or less at full employment, then if you have fiscal stimulus coming in this late in that cycle, then you're going to get inflationary pressures. What does that mean? That means the Fed has got a job to do, which is keep inflation around 2%, would be raising interest rates and tightening monetary much faster than the market is expecting. What would that translate into? Still only maybe 2.2% growth, but a stronger dollar and a weaker renminbi, for example. So that might be a different sort of situation from the Chinese perspective, and who knows, maybe then there'll be more focus on, well, you know, what's going on in China, why isn't, why are the Chinese weakening their currency in this kind of context.
And do you think QE has been totally terminated?
I think these days are gone now. I think it's about time to, you know, the stimulative stage is already behind us. We're in the mode of gradually hiking the rates. I think from U.S. side's perspective, the country is fairly lucky because right now the world commodity prices have been very, very low, very moderate, mostly because of the oil picture. And
shale gas revolution.
Yeah, exactly. And these are putting pressure on the oil price, and that helps a lot with curbing the inflationary pressure in the U.S. and also, you know, in other countries as well. So the commodity price, it doesn't look. Do you think that the commodity price is going to shoot up? I don't.
John may have delivered a picture about a rosy picture about the world economic growth by addressing the issue of low commodity prices. Do you think this is an opportunity for developing countries and emerging markets, but occurs for the resource-rich economies?
Well, I mean, the commodity price is really kind of reflected in what economists call the terms of trade. So if commodity prices are high, that's good for commodity exporters like Australia, Canada, Brazil. If they're low, that's great for importing countries like China, to a certain extent the US, and European countries. But I would agree that it doesn't look like commodity prices are going up, you know, particularly oil, which is a key commodity at any particular rate. And again, the shale revolution was mentioned. That really, seems to be a continuing process. It wasn't one and done. What our experts tell us is that there's continuing technological innovation and increasing the ability to extract more and more oil from the ground. You mentioned QE, Ray. If I just come back on that.
Excuse me, but we have to keep you guys waiting a little bit while our viewers will take a break. That's a dialogue about the impact of the latest tax overhaul plan approved by lawmakers in the Senate, whether it's going to affect the Chinese economy in the year 2018 or not. We'll come back in a few minutes. Please stay with us.
The U.S. Senate passed tax reform legislation last Saturday, and the public is divided on what this means for China. The main feature of the proposal is a reduction in the corporate tax rate to 20% from 35%. It also includes increased deductions for individual taxpayers and a reduction in taxes for partnerships. China's Deputy Finance Minister Zhu Guangyao says more attention should be paid to the tax overhaul's influence on enhancing America's competitiveness, raising labor productivity, and the wages of American workers. He also says the spillover effect of the reform cannot be ignored. Professor Hu Yijian from the Shanghai University of Finance and Economics says the reform will be beneficial to China's strategy of encouraging its companies to go global. It may also bring more money into the U.S. Professor Zheng Yongyan from the National University of Singapore holds a different view. He says, in his words, China is building a consumer society. The proportion of consumption-driven economic growth has been increasing. So the reform will not have much impact on the country.
Welcome back, gentlemen. Go back to what you want to say on the QE.
Well, just quickly on QE, because it's such an important issue for the markets. Economists look at QE basically as a stock issue rather than a flow issue. So the Fed now is gradually decreasing the stock of QE that's on its balance sheet. So it'll take several years before it's completely gone. But let's not forget the Bank of Japan and the ECB. You mentioned the ECB in your introduction. The ECB is gearing up to taper down its quantitative easing, but that's still going on a flow basis. So in other words, the ECB is still in the process of expanding its balance sheet, as is the Bank of Japan. So we still have two of those three major central banks that are doing QE on a fairly aggressive scale, and that's going to be, I think, with us for some time.
What would be the impact on Abenomics in Japan? The appreciation of Japanese yen, the stimulus package, except for the structural reform of the Japanese economy. That's the third arrow of Abenomics, and the most difficult.
I think these are all marginal impact, because the fundamental problem is the population. Japan they've tried all kinds of ways. They probably have exhausted all the tools in the economics dictionary.
Population is a common concern for Russians, the Germans, and the Japanese. Almost all of the old economies.
Yeah, I mean, what's driving the situation in Japan has been like this for how long? At least, they used to talk about the lost decade. Now it's the lost generation, right? I mean, it's always been like this.
It's almost 2 decades, a lost decade, since the Plaza Accord in the 1950s.
Right, so they're projected to have less than 1 million population every year. So 1 million people are disappearing. And you go to shopping malls in Tokyo, for example, mostly all elderly people, storing in the shopping centers. People of that age usually don't buy a lot of things.
We'll soon enter into that golden age of having so many old people.
Just on Japan. Now, John's right in terms of the aging of the population and the shrinkage of the population. But what is interesting to me, I lived in Japan 17 years over an extended period, so I followed this very closely. But things are starting to change a little bit, Ray. A couple of years ago, the government finally sort of acknowledged this problem and said, look, we can't really stop the population from shrinking. It peaked at 128 million, but at least let's draw a line in the sand and we not let the population fall below 100 million. They haven't quite figured out how to do that. But another interesting statistic was last year, for the first time, the number of foreign workers in Japan surpassed the 1 million mark, and that's been rising quite rapidly. So one of the safety valves here is really to bring in more foreign workers. And you often hear that, oh, Japanese, they don't have immigration, etc. That's not true. The economic forces do drive
well,
a more
overseas
pragmatic
immigration
response.
might be a good idea, but should we look into the future and address the issue of AI, the use of robots and artificial intelligence will help create more job opportunities? It's a matter of whether we're going to have more unemployment rate or not, because so many economists are crying foul today about, if you look at what happened at the latest World International Conference in Wuzhen, Zhejiang province, I mean, IT elites have all been talking about AI age, what it means for the sustainability of the world economy, particularly the Chinese one. And when we were discussing Japan, do you think Prime Minister Shinzo Abe should also give a second thought about this?
Right. Well, right in terms of AI, I think clearly right now there's a race on the two sides of the Asian Pacific Ocean. You know, U.S. and China putting a lot of money into development of AI capabilities. Actually, I attended a conference by the VC capitalists, the annual convention just a few weeks ago, and the conference all about AI development in this area. And I got to know that China is actually doing quite well. They mentioned a couple of reasons. First of all, AI is really an industry with a strong economy of scale. You need a lot of data. You need we have a lot of people, so hence we have a lot of data, and also China.
We have a lot of data, but we have little privacy.
This is actually a good thing. No, this is actually a good thing. I was just about to mention this. Sort of a more lenient, more loose, a little bit more loose privacy protection regime helps the development of AI. And somebody even mentioned that China is an atheist country, whereas U.S. is a country of faith, I guess, right? And that also helps with.
I'm not a big fan of being an atheist society.
Well, that's an argument. They mentioned that it can actually facilitates the development of AI technologies. And also.
That's interesting. Just on, maybe a comment just on this AI issue.
Right.
The robots are coming. It's often portrayed as a very dystopian kind of future.
Is it a utopian future?
Well, I mean, I think it's probably more utopian than dystopian.
We have exaggerated the impact a little bit.
Well, here's the point I would simply make, that what basically robotics and machine learning and artificial intelligence, all of these things mean is that we will be able to either do things that we couldn't do before with the same resources, or produce essentially the same kind of level of output with fewer resources. So either way you look at it, this is a good thing. This is called productivity. This is called human progress. Where it's a problem is, I think the word we haven't used today is inequality. That you have these winner-take-all kind of effects. The people who develop the AI and grab the market, they become multi-billionaires, and a lot of people are left behind. So I think this whole AI, robots are coming kind of discussion, and we need to turn it around more as really an issue of how do we deal with the income redistribution consequences, which can provide challenges.
Yes, income redistribution would help a lot in stimulating
thing.
domestic spending, which I believe will be the driving force behind the sustainable growth of the Chinese economy. But when we look back and look into the future, John and Paul, what are your basic assessments of the Chinese economy in the year 2018? Do you think it will still rely on e-commerce, the boom of online payment, as well as sharing bicycles? I mean, to say nothing of, say, the high-speed railway. These are said to be the four major innovations in the 21st century that will sustain the Chinese economy. But what are your forecasts?
Well, I mean, I think the most likely outcome is really some kind of continuation of the recent trend, which is growth around 6.5%, been a little bit higher, but let's say around about that zip code. And I think you put your finger on a couple of interesting points. The Chinese economy, of course, is a couple of different economies. One is the more infrastructure intensive, a little bit more government influenced economy, and the other one, of course,
is that bad thing? Is that a curse for the Chinese economy to have the government control the segment of the economy?
I don't think so. I mean, I think every
you
economy.
don't think SOE is a necessary evil, or it's the other way around?
Well, I don't think. I think every economy is some kind of mixed economy. I think that over the longer term, SOE reform.
Professor John and Professor Zhang Wei will seriously disagree with you. They would say, as the market fundamentalists, they would challenge any intervention by the government. They would say, liberal market economy is the only therapy, the only way out. Other than this, all others would be garbage.
Well, he wants to throw the China's anti-monopoly law out of the window. I've been in the same room with him discussing this. He doesn't believe in this stuff at all. so he's a radical.
These guys produce a great influence on the public opinions.
No, I think the question is around what is where do you draw that border between the more government-influenced part of the economy and the much more dynamic, entrepreneurial, digital economy, for example, and how you shift that border over time. It's not a static picture.
I totally agree with you, but I just want to add one note. I think the first economy you talk about, infrastructure-driven economy, is also having a outward-going aspect as well because of China's Belt and Road Initiative. Yeah, and we're making a lot of investments in other countries. So the sort of
what are the deliverables for the BRI? The Belt and Road Initiative.
You mean the...
You talk about the infrastructure-led growth,
right.
But given the tightening of the grip, overflow of the capital, what do you think of the feasibility of having more of the Chinese investment in overseas projects?
I still think that they're going very strong. I think especially government-sanctioned projects. Those infrastructure projects related to, for example, ports, railroad, electricity, telecommunications in developing countries, in Africa, for example, they are doing very well. I know several projects in Africa, in Ethiopia, in Djibouti, in Tanzania, for example, in Kenya. They're all doing quite well. I mean,
and Pakistan.
And of course, in Pakistan, we put a lot of money into Pakistan. So these projects will still go. They have their, it's a continuous thing. It's not going to stop anytime soon.
But most of the investment, I'm afraid, have been made by the policy banks of China. I mean, non-public sector would hesitate, would give a second thought as to, wait a minute, what about the risks? They would consider, they would take into consideration the risks geopolitically and politically. In the African countries.
That I 100% agree. That I 100% agree. Certainly there are risks, but these projects, I think these are mostly sort of state-level big projects. As in that sense, they usually require, the other government's guarantee, for example, for return of.
What about the issue of local debts in China?
Well, I think that is I think that the issue of debt more generally, I think the local debt issue is one part of a broader debt picture. I think when a lot of foreign observers look at the Chinese economy, if they were to worry about one thing, and one thing would sort of stick out like a bit of a sore thumb, it is the elevated debt situation, particularly in the SOE sector, corporate sector, and local government sector. So China needs to figure out ways of dealing with that and making sure that it doesn't become a destabilizing influence. And perhaps when it comes to local government finances, Ray, one thing which could probably go a long way is greater transparency about exactly what the plumbing is and what the assets are, and so that the outside world, including even the Chinese government itself, the central government, gets better visibility into what exactly is going on at the local level.
Thank you very much for giving us a very encouraging picture about the economic prospects. However, we should never underestimate other negative factors that may prevent China from getting integrated with the rest of the world. For example, China is still denied the full-fledged marketing up status despite the grace period of up to 15 years. China is still facing the anti-dumping, anti-subsidy investigations from the European Union and from the United States of America. Whether that will prevent the trade deficit or the other way around, I don't know. But there's a lot of uncertainty in the year 2018. I thank John and Paul for giving us a rosy picture. I thank you for being with us. Until next time, goodbye.